A few weeks ago, Goldman Sachs forecasted that the S&P 500 would only deliver a real return of 1% annually over the next decade, which has reignited concerns about a potential lost decade for the stock market. This idea suggests that, similar to Japan in the 1990s, the US could experience a prolonged period of economic stagnation where stock market returns are essentially flat. Well-known investors, including Ray Dalio and the late Charlie Munger, have voiced concerns that stock returns may be disappointing over the next 10 years. The lost decade concept refers to a period where investors see no growth in their wealth. For example, if you had invested in the S&P 500 before the tech bubble burst, it would have taken until 2007 to break even, after 7 years of no progress. Following that, the global financial crisis caused another 5 years of stagnation, leading to a total of over 12 years of no gains. What investors like Munger, Dalio, Michael Burry, and Jeremy Grantham are cautioning is that with the S&P 500 at all-time highs and U.S. companies appearing overvalued, today's investors could be entering a similar scenario of prolonged market weakness. Here's Charlie Munger in one of his final interviews.
The next 10 years to have lower returns in the equity markets than the last 10? He doesn't give us an idea why?
The answer is yes.
And could you give us a hint as to why that might come to pass?
Yes, because so many people are in it and the frenzy is so great and the systems of management, the reward systems are so foolish that I don't think it's going to work at all. I think the returns will go down, yes. In real terms, the returns will be lower.
Charlie's prediction about low returns has some nuance, particularly around the concept of real returns. Real returns account for both stock price movements and inflation. For instance, if you invested in Tesla a year ago, the stock rose by 30%. However, factoring in inflation at 2.4%, your real return would be closer to 27%. Similarly, if you invested in an S&P 500 index fund in June 2021, you would have seen a massive 3% return, but with inflation rising 9.1% during that period, your real return was much worse. It's crucial to consider inflation when evaluating returns, since an investor's main goal is to outpace inflation and grow wealth. Between 1970 and 1981, the S&P 500 rose just 32.58%, but inflation jumped by 128.31%, leaving investors with a 42% real return. This highlights Charlie Munger's key argument: inflation can severely erode returns. Charlie warns that high inflation could persist over the next decade, keeping real returns low. In a 2020 interview, he noted the U.S. Federal Reserve's massive money printing efforts, which expanded the money supply by 89% in a year. Although the Fed recently lowered rates, its balance sheet remains almost unchanged. The U.S. deficit is a major concern. With rising costs for defense, healthcare, infrastructure, and the shift to renewable energy, inflation could widen the deficit. If global demand for U.S. Treasury bonds drops, countries like China and Russia may pull back, forcing the Fed to buy more bonds, which could fuel inflation further. Charlie argues that this ongoing money printing trend is inflationary and will negatively impact investors' real returns over time. Additionally, Warren Buffett has raised similar concerns about the long-term effects of the growing U.S. deficit. A growing concern is the likelihood of increased taxes as the U.S. faces a widening deficit. Warren Buffett has warned that both individual and corporate taxes may rise over the next decade to help address the financial imbalance. While taxes aren't directly factored into real returns, they can significantly impact your take-home profits. Higher taxes on gains would reduce the money investors keep from their investments. Warren himself cited the potential for higher taxes as a key reason for selling much of his Apple stock, despite still believing in the company's long-term prospects.
We are paying a 21% federal rate.